Everyone knows the name Blackstone. It's the biggest financial institution in the world and was the first to reach more than $1 trillion in investments under management. But the bigger they are, the harder they fall. The largest investment institution in the world claims that the downfalls in the banks are due to the after effects of the pandemic. But they also deny any talk of their monopolies, which they have in residential housing markets and many more. So why is Blackstone denying all of these claims being made against them? Is Blackstone trying to hide their trillion-dollar collapse? Are these all linked to the SVB collapse that happened in early March of this year? If you're interested in the answers to these questions, then watch this video till the end to find out more. Most of us know Blackstone as a huge banking asset that claims to have bank assets and holdings worth more than $1 trillion. But what most of us don't know is that the giant financial institution is on the edge of a huge collapse, and it seems that an impending course of events is bringing Blackstone closer to that final step of collapse with every passing day. In November 2022, Blackstone said it had prevented investors from paying out their assets in its $71 billion residential real estate income trust as the venture capital giant continues to deal with a flood of redemption requests from investors. At that time, the stock of the world's largest alternative asset manager fell 16.8%. This went on for almost 5 months, but Blackstone kept on refusing the investors on withdrawing their capital from the company. Investors were knocking at Blackstone's door, but Blackstone had no answers to give them. Now, is this a bank run of Blackstone's that the investors want to take their assets out of it? Well, technically, Blackstone is not a bank, and we can't really call it one. So this isn't a bank run. That said, it does seem like the financial organization is not doing so well. In fact, Blackstone had said in a report that they have the legal right to seize the capitals of investors, and that the investors have no legal course to challenge that. But no matter what sort of excuses or claims are given by the financial organization, they simply can't change the fact that its $100 billion of its staple has been losing its value, and the investors are worried about their assets. And this is what's making them get their financial holdings out of this financial institution. Things got worse for Blackstone when it went bankrupt on a €531 million or $562 million bond supported by an investment portfolio of Finnish offices and stores. According to persons familiar with the scheme, Blackstone, which purchased landlord Sponda Oy in 2018, requested a delay from holders of the packaged bonds to get rid of assets and pay the debt. Bondholders voted against a further extension, according to the sources who asked not to be identified because the sales procedure was not open to the public. Property values in Europe are falling as rising interest rates deter purchasers until it is apparent how far rates will rise. This has resulted in significant disparities between bids and offers, restricting deal volumes and placing pressures on owners with aging loans. According to a Scope Ratings report published in January, around 1/3 of all loans in commercial mortgage-backed securities expiring in 2023 and 2024 face high refinancing risks. So, will Blackstone be able to pay this $562 million debt? Well, according to the current circumstances, the real estate market and the property prices are declining day by day, which also means that this debt that Blackstone has to pay is unprofitable, and they can't repay it until markets get stable. Blackstone did go to the bondholders, requesting them to extend the due date of the debt. However, their request was refused, and this has made things even worse for Blackstone than they already were. As for Blackstone itself, this debt is nothing to be worried about, as claimed by its sources that this debt is related to a smaller portion of the Sponda portfolio, and that they have full confidence that the management team of the Sponda portfolio will come up with a solution. Now, this is an interesting point to notice. If debt is not a big deal for Blackstone, and they have what it takes to pay it off, why don't they just pay it off? Well, all of this comes down to vague and corrupt accounting rules. Just like the collapse of Silicon Valley Bank, which happened because of the mismanagement of the shareholdings and corrupt accounting rules, the same applies here. Blackstone generated $1.27 billion in 2022, and gave out $5 billion worth of assets to its investors. Blackstone is allowed to value its assets wherever they feel that it will be the best for the company. Here's an example to explain. If Blackstone purchased a building worth $100 million, and a year later they doubled the worth of the asset, claiming it to be $200 million, then the new value becomes the new worth of that property. In this way, Blackstone can earn a profit of $100 million, which they can then share with their shareholders later on. And that is exactly what they have been doing over the course of the year 2022. Blackstone was continuously increasing the worth of its properties in 2022, and they did it right when the prices of the properties were declining in all of the rest of the world. Now here comes another very important question. Why didn't we get to know about this before? Well, the answer is very simple. Most of the property companies and market shareholders want us to believe that everything's all right, and that nothing much is really happening. Although the experts and market watchers did express concern that the failure of Silicon Valley Bank, along with Signature Bank and Silvergate Bank, could cause an outbreak that could spread to the rest of the financial system. That said, the CEO of Blackstone says they do not believe that will happen, due to the specific tech-based frenzy surrounding SVB. Schwartzman, whose firm controls $975 billion in assets, went on to say that the present banking turbulence was not a conventional crisis. Instead of keeping riskier assets, SVB had a disparity of otherwise relatively secure bond assets maturing over a longer time frame. The value of such bonds fell when the Fed raised interest rates, but they would have been returned in time if not for the bank crisis. But the actual reasons deny what Schwartzman, the CEO of Blackstone, has to say about the bank's crisis. Following run-on payments caused by money concerns, regulators shut down SVB in a shocking move that continues to resonate throughout the banking system and financial markets. To meet its capital needs, the bank was compelled to sell long-term treasury notes at a decline due to raising interest rates eating away at fundamental value. Now, we are all aware of the fact that an American banking crisis seems to have started and Blackstone is also affected by it. Although up till now they have managed to present a pretty picture that looks like everything's under control and normal, it's actually not. Soon after the collapse of the Silicon Valley Bank, Blackstone rushed to buy its loan book at the time when all other banks were at a downfall. Now, this might sound crazy, but in the middle of all this, JP Morgan tends to believe that Blackstone is doing alright, and even considered Blackstone its top pick in terms of financials, ahead of a Fed pivot. JP Morgan claimed in January that Blackstone is the best financial institution in its class, and that we should all go and invest in it. It all seems pretty strange and weird, as JP Morgan was watching Blackstone go through a downturn, with all its investors screaming to take their capital out of the firm, and still, JP Morgan was considering Blackstone the best investment firm around the corner. What adds even more spice to things is that JP Morgan was also doing the exact same things Blackstone was doing with the SVB right before it collapsed. According to some other sources, Blackstone is now considering attracting non-institutional investors for the company's future. Why is Blackstone doing so? Blackstone has always been given the place of a high-end investment organization, and it has always given its attention to the bigger fish in the market with big names. But right now, since the organization is running out of investors, and a majority of them are asking to have their investments back, Blackstone is trying its best to keep up with the problems and generate more capital by having more investors, regardless of the fact that those investors are individuals and not institutions. Things will get worse, or rather unimaginably disturbing for Blackstone, if they are not able to repay their debts in time. And as the company is receiving heat from its customers day by day, it seems like the future of this financial institution is right on the line. What are your thoughts about Blackstone's position? Let us know in the comments section what you think Blackstone will do now. If you found this video interesting, hit the like and subscribe button, and turn the notification bell on so you always get informed on time with good economic content. Thanks for watching.